7 stocks represent 32% of the entire S&P 500. 7 companies out of 500. Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Tesla. 32% of the index. 32% of trillions in passive investment funds. 32% of your 401k if you own an S&P 500 index fund. This is the highest concentration since the Nifty 50 era of the early 1970s. And we know exactly how that ended. When the market turned, those 50 stocks didn't just underperform, they collapsed. The concentrated positions that everyone owned became the positions everyone sold. The flow that drove them higher reversed violently. Wealth destruction was catastrophic. It's happening again. Right now, and the billionaires see it. That's why Warren Buffett is selling Apple. That's why Bill Gates reduced Microsoft by 55%. That's why Jeff Bezos dumped Amazon. They're getting out before the concentration unwinds, because when it unwinds, the mechanism is mathematical. Passive flows that bought automatically will sell automatically. And when $20 trillion in index funds start selling the same 7 stocks simultaneously, there's no bottom. Just a liquidation cascade that feeds on itself until destruction is complete. Let me show you exactly how concentrated the market has become, why this concentration is unsustainable, and what happens when unwinding begins. Start with the numbers. The S&P 500 is market capitalization weighted. Larger companies have larger weight. The 7 largest, Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla, have a combined market cap of approximately $15 trillion. The entire S&P 500 has approximately 47 trillion. 7 stocks represent 32% of the total. But it's worse, because these 7 stocks represent even more of the index's gains. Over the past 2 years, these 7 contributed approximately 70% of the S&P 500's total return. The other 493 contributed only 30%. The index has been rising almost entirely because of 7 companies. Everything else has been flat or declining. This creates an illusion. Investors look at the S&P 500 hitting all-time highs and think the market is strong. But the market isn't strong. 7 stocks are strong. The other 493 are mediocre at best. And when those 7 stocks turn, the entire index turns. There's no diversification. There's no safety in numbers. It's concentration risk disguised as broad market exposure. Now, let me show you why this concentration happened and why it's unsustainable. The concentration is a result of passive investing dynamics. Over the past 15 years, passive index funds have grown from managing $2 trillion to over $20 trillion. Investors pour money into S&P 500 index funds. Those funds mechanically buy stocks in proportion to their market cap weighting. The largest stocks get the most inflows. This creates a self-reinforcing cycle. Microsoft is large, so index funds buy more Microsoft. That buying pushes Microsoft's price higher. As Microsoft's price rises, its market cap increases. As its market cap increases, its weight in the index increases. As its weight increases, index funds must buy even more Microsoft to maintain proper weighting. The cycle continues. Price up, weight up, more buying, price up further. This worked beautifully on the way up. The Magnificent Seven became magnificent because passive flows pushed them higher continuously. Every dollar flowing into index funds disproportionately went into these 7 stocks. They benefited from the structural bid that passive investing created. But the same mechanism that drove them higher will drive them lower when flows reverse. Here's why. Index funds don't have discretion. They don't analyze fundamentals. They don't make value judgments. They mechanically buy and sell based on market cap weighting. When money flows in, they buy the largest stocks. When money flows out, they sell the largest stocks. It's automatic. It's emotionless. And it's about to become devastating. Because when the market turns, when investors start pulling money out of index funds, those funds will mechanically sell the Magnificent Seven. Not because the fundamentals deteriorated, not because the companies are bad, simply because the funds must sell the largest positions to raise cash. And when you have $20 trillion in passive funds all programmed to sell the same 7 stocks simultaneously, the selling becomes a cascade. Let me show you the liquidation cascade mechanism. Phase 1, market turns. Something triggers a sell-off. Recession fears, Fed policy mistake, geopolitical crisis, corporate earnings miss. Doesn't matter. The market declines 5%. Investors get nervous. Phase 2, redemptions begin. Investors pull money from index funds. Not panic yet, just prudent rebalancing. Index funds receive redemption requests. They must raise cash. They sell their largest holdings first because those are the most liquid and represent the most value. Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Tesla. Heavy selling pressure on these 7. Phase 3, prices decline. The Magnificent Seven start falling, not gently, sharply. Because the selling is concentrated and relentless. As prices fall, market cap declines. But here's the problem. These 7 stocks represent 32% of the index. When they fall, the entire index falls. The S&P 500 drops 10%, then 15%. Phase 4, More redemptions. As the index falls, more investors panic, more redemption requests. Index funds must sell more, but now they're selling into declining prices. The very act of selling pushes prices lower, which triggers more redemptions, which requires more selling. The feedback loop accelerates. Phase 5. Forced selling cascade. Margin calls hit. Leveraged investors get liquidated. They must sell. Options dealers who are hedging call options must sell stock as prices fall. Systematic funds that allocate based on volatility reduce equity exposure as volatility spikes. Everyone is selling. And everyone is selling the same 7 stocks because those are the largest positions. Phase 6. Liquidity evaporates. The bid-ask spreads widen. Market makers step back. There are no natural buyers at these levels because everyone who wanted these stocks already owns them through index funds. The only buyers are opportunistic traders trying to catch falling knives, but they're overwhelmed by the selling pressure from $20 trillion in passive funds. Phase 7, the crash. Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Tesla, all down 40-50% from peak. The S&P 500 down 30 to 40% because these 7 stocks were 32% of the index. Trillions in wealth destroyed. Retirement accounts decimated. And the billionaires who sold early, Warren Buffett with his $325 billion in cash, Jeff Bezos with his $8.5 billion liquidated, Bill Gates with his reduced Microsoft position, they're sitting on the sidelines waiting to buy back in at half price. This isn't speculation. This is mathematics. This is the inevitable result of having 32% of the market concentrated in 7 stocks, while $20 trillion in passive money is programmed to buy and sell them mechanically based on flows. The concentration creates fragility. The passive structure creates the liquidation mechanism, and the combination creates catastrophic downside when the cycle reverses. Now, let me show you the historical precedent because this has happened before. The Nifty 50 era of the late 1960s and early 1970s. 50 stocks, all large cap blue chips, became the darlings of institutional investors. Everyone owned them. They were called one-decision stocks because you just bought them and held forever. Companies like IBM, Coca-Cola, McDonald's, Disney, Polaroid, Xerox, the best companies in America. Institutional investors poured money into these 50 stocks. They represented safety. They represented quality. They represented inevitable growth. The concentration increased. By 1972, these 50 stocks traded at extreme valuations, P/E ratios of 50, 60, 70 times earnings. But nobody cared. They were the Nifty 50. They couldn't fail. Then the market turned. 1973, 1974. Recession hit. Inflation accelerated. The Fed tightened. The Nifty 50 collapsed. Not down 20%, down 60, 80% from peak. Polaroid fell 91%. Xerox fell 71%. Even the quality companies fell 50, 60%. The concentration that drove them higher drove them lower with equal force. The institutional investors, who all owned the same 50 stocks, all sold simultaneously. And the wealth destruction was catastrophic. Sound familiar? The Magnificent Seven today are the Nifty 50 of 1972. Extreme concentration. Extreme valuations. Everyone owns them through index funds. They're considered safe because they're large and liquid. But concentration is never safe. Concentration is fragility disguised as strength, and when it breaks violently. Let me show you the valuation problem because expensive concentration is worse than cheap concentration. Microsoft trades at 33 times earnings, Apple at 33 times, Nvidia at 48 times, Amazon at 50 times, Meta at 28 times, Alphabet at 27 times, Tesla at 95 times. These are not cheap stocks. These are priced for perfection. Any disappointment, any earnings miss, any growth deceleration, the valuations collapse. The weighted average P/E ratio of these 7 stocks is approximately 40 times earnings. The S&P 500 average P/E ratio is 22 times. These 7 stocks are trading at nearly double the market average, and they represent 32% of the market. That means the index is being held up by overvalued concentration. When these stocks reprice to reasonable valuations, say 20, 25 times earnings, they fall 40 to 50%, and the index falls with them. Now let me show you what the billionaires are doing, because they see this concentration risk clearly. Warren Buffett reduced Apple from 50% of Berkshire's portfolio to 30%. He sold 300 million shares. Apple is still his largest position, but he's reducing exposure to the most concentrated part of the market. He's not betting against Apple as a business. He's reducing exposure to the concentration risk. Bill Gates reduced Microsoft by 55%. Microsoft used to be 28% of the Gates Foundation portfolio. Now it's 13%. Again, not because Microsoft is bad, because concentration is dangerous. Gates is diversifying away from the Magnificent Seven into boring defensive stocks. Waste Management, railroads, Berkshire Hathaway. Assets that don't have 32% concentration risk. Jeff Bezos sold $8.5 billion of Amazon in 9 days. Amazon is part of the Magnificent Seven. Bezos liquidated and converted to cash. He's not holding other tech stocks. He's holding cash, waiting for the concentration to unwind so he can buy back cheaper. Jamie Dimon sold JP Morgan for the first time in 19 years. JP Morgan isn't part of the Magnificent Seven, but Dimon sees the systemic risk. He knows that when the Magnificent Seven collapse, they'll take the entire market with them, including financials. He's getting out before the contagion spreads. These four billionaires, Buffett, Gates, Bezos, Dimon, all see the concentration risk, all reducing exposure, all raising cash, all positioning for the liquidation cascade. And when the four smartest investors in the world are all doing the same thing, you should pay attention. Now let me show you the timeline, because this isn't a distant threat. The concentration has reached extremes. The passive flows are starting to reverse. The redemptions are beginning. The mechanism is activating. Phase 1 to Phase 7 could unfold over 6 to 12 months, maybe faster if a catalyst triggers panic. What's the catalyst? Could be anything. Recession, earnings disappointments, Fed policy mistake, geopolitical shock, AI bubble bursting when companies realize $200 billion in AI capex isn't generating returns, corporate debt crisis when companies can't refinance, commercial real estate collapse spreading to banks. Any of these could trigger the selling. And once it starts, the concentration ensures it accelerates. Here's what you need to understand. If you own an S&P 500 index fund, you have 32% exposure to 7 stocks. That's not diversification, that's concentration. And when those 7 stocks fall 40, 50%, your index fund falls 30 to 40%. Even if the other 493 stocks are stable, the concentration destroys you. The solution is to reduce exposure to these 7 stocks specifically, not by shorting them, not by betting against them, simply by reducing concentration. If you're currently 100% S&P 500, consider shifting to equal weight index funds where all 500 stocks have equal weight. Or shift to value-focused funds that own smaller, cheaper companies. Or shift to international funds that don't have Magnificent Seven concentration. The goal is to not be holding 32% concentration when the liquidation cascade begins, because once it begins, there's no exit. The passive selling is mechanical and relentless. The prices fall and keep falling until all the forced sellers are done, and then they fall further because everyone who bought index funds is underwater and panicking. The Magnificent Seven represent 32% of the S&P 500, the highest concentration since the Nifty 50, and the billionaires are reducing exposure. Buffett selling Apple, Gates reducing Microsoft, Bezos liquidating Amazon, Dimon exiting JP Morgan. They see the concentration risk. They see the liquidation cascade mechanism. They see what happens when $20 trillion in passive funds all sell the same 7 stocks simultaneously. The warning has been delivered. The math is clear. The precedent is obvious. 32% concentration in 7 stocks. Passive flows reversing. Liquidation cascade waiting to activate. The question is whether you'll reduce your exposure before it begins or whether you'll be caught in the cascade when it starts. Because once it starts, there's no escape. Just 7 stocks falling together, taking the entire index with them, destroying trillions in wealth while the billionaires sit on cash, waiting to buy everything back at half price. The concentration is catastrophic. The mechanism is mathematical. The outcome is inevitable. The only question is timing. And based on what the billionaires are doing, the timing is now.